In this video, we will talk about 3 most common cryptocurrency trading strategies. There is no one-size-fits-all answer to this question, as the best trading strategy for cryptocurrency will depend on a variety of factors, such as your risk tolerance, investment goals, and the specific cryptocurrency you are trading. In general, however, some common strategies for trading cryptocurrency include dollar cost averaging. Dollar cost averaging is a trading strategy that involves investing a fixed amount of money in a cryptocurrency at regular intervals, regardless of the price. This can help to reduce the impact of volatility on your investment and can be a good strategy for long-term investors. For example, let's say you have decided to invest $100 in a particular cryptocurrency every week. If the price of the cryptocurrency increases, your $100 investment will buy fewer units of the cryptocurrency. If the price decreases, your $100 investment will buy more units of the cryptocurrency. Over time, this can help to average out the price you pay for the cryptocurrency, reducing the impact of volatility on your investment. Trend trading. Trend trading is a strategy that involves identifying a particular trend in the market and buying and selling cryptocurrency based on that trend. For example, if the market is trending upwards, you might buy cryptocurrency and hold on to it until the trend reverses. If the market is trending downwards, you might sell your cryptocurrency to avoid losing money. Trend trading can be a good strategy for traders who are able to accurately identify trends in the market and who are comfortable holding on to their investments for longer periods of time. Arbitrage. Arbitrage is a trading strategy that involves taking advantage of price differences between different exchanges or markets. For example, if you notice that the price of a cryptocurrency is lower on one exchange than on another, you could buy the cryptocurrency on the cheaper exchange and sell it on the more expensive exchange, making a profit in the process. Arbitrage can be a good strategy for traders who are able to quickly identify and act on price differences between different exchanges. However, it can be a risky strategy, as it requires a significant amount of capital and can be impacted by factors such as transaction fees and market liquidity. It's important to note that cryptocurrency trading can be highly volatile and carries a significant amount of risk. It's essential to do your own research and carefully consider your own financial situation before trading cryptocurrency. What strategy do you use to trade cryptocurrencies? Let us know down in the comments. If you like this video or find it helpful, then consider liking and subscribing.